Hi, my name is Roger Schluter. This video is actually about if you have an existing business and you are evaluating their financial statements, really kind of what the bank looks for. Um, the bank really wants to put these financial statements on a spreadsheet, and the spreadsheet will really look at the profit and loss, and not the balance sheet, because the profit and loss is really what pays for the loan. So really, that's what they're going to focus on. If you're an existing business, they may also want balance sheets, but really, on when you're doing a short business proposal, you really want to look at it just looking at the P&L. In looking at that, what the bank wants to see is they want to see a history of 2 or 3 years. Um, and actually what you'll do is you'll actually put them, there's a form that hopefully is going to be on this video, that is really a history of, and history of the projected cash flow. And you can do both on one form, and I think this one does. I think this one actually has, and this is a long time ago, it has a 2014 year. And that's all the business was open. It was open 1 year. And then it has 3 years for a projection. And the 3 years, what the bank wants out of these things is the bank wants businesses that sales are growing, earnings are growing, and they want to see that the expenses aren't getting out of control. So looking at this form, really what we're looking at is we're looking at the sales. And looking at this one, the sales are going up. Well, we are looking at projected numbers though. So anyway, and then they're looking at the expenses, and how are these done. Now, normally when you have the existing company, and this is just 1 year because they only had 1 year. Normally you'd have like 2 to 3 years across, and then you would look at the sales and say, are they going up? Are they going down? Cost of goods sold, is it being steady? Cost of goods sold is usually all the costs that really vary with sales. And then you've really got the SG&A, which is really just all their other expenses. A lot of times what banks will do is they'll put the SG&A, they'll itemize out a few things like officer salary, depreciation, other income, but a lot of stuff they'll go ahead and just put in the sales and general administration category, and then they'll itemize out some of those other ones. Because really, banks are looking at increased sales, and they're looking at increased earnings, and they're looking that the expenses kind of stay the same. So if that's what your business is doing, then you really, if you need a loan, you really need to go talk to a bank, because that's the kind of things they like. Now, the projections are done on the exact same form. And you want to look at them exactly and side by side. A lot of times you'll have the 2 or 3 years of the actual statements, and then on the next page you'll have 2 or 3 years, usually 3 years of projected statements. And projected, I mean, sales are the key here for you, because you have to hang your hat on something, and you have to come up with an assumption of how they got that sales figure. And then the expenses going down the line, you got to have assumptions for all those expenses also. So it's not only just having the numbers, you could pull those out of the sky, pull them out wherever you want, but you really need to have assumptions of how these values are there. To give you an example, sometimes if you were somebody who's in the business, you could say, well, I've worked in this business for 20 years. With my experience, I feel like we could do this amount of sales, the first year. And then it's always good to maybe tack on, depending if it's a growth industry, maybe you want to tack on 5% the first year, or the first year of the projection, and then 10 or 15. And it really depends. And you do have to kind of back that up. Expenses are a lot easier to project. And even your normal expenses, to show that they're good. Franchises are very easy. Usually the franchisor will know in a certain population area what their stores will do sales wise, and usually they'll have example of expenses also. So when you're looking at expenses, you do want to look at the ones that are a given. Let's say you call a trash provider and say how much for trash. He gives you a number. You know what the rent is because you've already looked at space and you know exactly what the rent is per month. Um, it's those variable costs. So let's say you're selling shirts, and you have an inventory of shirts. Then really that's your cost of goods sold, and then you have a markup. And so that would be, those are variable costs, the costs that go into selling that item. Any cost that goes up or down with with the sales is really a variable cost, and anything like a rent would be a fixed cost. Now, I said before that the sales are the hardest, and they really are to project. You got to hang your hat on something, and you got to have some assumptions that of why these sales are this much. Expenses are different. Expenses you can actually, like I said, you could use the real ones, or you could go ahead and project and say, hey, I talked to the electric company in this space, they told me that the electric cost would be X. Another way to do is use the RMA book. On expenses, there's a publication called RMA, and it is actually stands for Risk Management Association. It used to be called Robert Morris. I keep thinking of Robert Morris and Associates. But anyway, what they do is they take a whole bunch of financial statements from a whole bunch of industries, and they put them together, and then they look at the expenses. So basically your sales will be 100%, and then it'll show you the expenses of that type of industry and that type of business. It'll show you the expenses, the percent of sales. So once you have sales, expenses can be pretty easy, especially if you look through this Risk Management Association. And it is what it is. It's their statement studies, and their statement studies are the ones that have this information, this expense information, and it's very valuable. SBA banks both look at those statement studies as pretty accurate and pretty good information. What you're really doing here on this P&L is you're basically putting your sales and your expenses down, and then what the bank's going to do is they're going to say, okay, what's the debt? What is the cost per month, cost per year of the new debt? On a brand new company, you're not going to have any projected debt, but if you had old debt, you'd put it with it. And basically you're going to look at the annual debt service of that. And what you're going to do is you're going to look at your earnings per year, and then your debt service per year. And then you're going to go ahead and divide your profit, and it should be your cash flow, but normally when you're doing this, if you're kind of a startup, the only fees that are really non-cash are depreciation and some other non-cash charges, which you're really not going to have. And a lot of times existing companies, you don't have much on that. So anyway, you want to use your P&L without those non-cash expenses becomes cash flow. And so your cash flow number would be your bottom line, what you're making from this business. And then you want to go ahead and take the debt, take the cash flow and divide it by the debt. And that's going to be your debt service coverage ratio. Now you want your debt service coverage ratio to be 1, because the debt will basically be covered by the profit, but you want it to be over 1. So banks want a 1.2 to 1.3. SBA minimum is probably a 1.1, but the higher the better. I mean, I've seen companies that have the cash flow is their coverage ratio is like 3 or 5 or whatever. Now those the bank would feel a little better about, but they are hanging their head on just that sales, those earnings, to satisfy that debt. Banks now, we're probably not going to get into this on this, but a lot of banks will go ahead and do the debt service coverage ratio, and they'll do that, but then they'll also put your personal income and your personal debt in there. So they'll add up the business income, the personal income, and then they'll add up the business debt and the personal debt, and then they'll do another a cash flow or a debt service coverage ratio using the whole thing. These projections are really called a global cash flow, where it brings in the personal and the business. And a lot of banks will look at that too. So yeah, that's one thing that you might just want to go ahead and project yourself so you know what it is. Um, but projections, it's kind of an art. It's not an absolute. So a lot of times when you're doing it, you can show certain things, and it is you're not you're just kind of putting your best foot forward. You're covering it. Most banks are going to know you're not going to show a loss. You're not going to show sales or earnings going down. You're always going to show them going up. So they're kind of aware of this. So I wouldn't really fudge it a whole lot. But you do want to make sure that everything's going up, that everything's going the way you want it to go. But anyway, thank you very much, and I'll see you in the next video. Oh, if you did like this video, if you got some value out of it, please like the video. And if you want to see more content like this, please go ahead and subscribe. And I'll see you in the next video.